Welcome back to the deep dive. Our mission here is simple. Take that big stack of complex intelligence on a really critical topic and pull out the essential knowledge you need to get across it. Today, we are doing a deep dive into NIO Inc. They're one of the most talked about, maybe most polarizing players in the global electric vehicle space.
Yeah, definitely polarizing.
Hmm.
And we're digging into a pretty comprehensive value investors report.
Mhm.
All the data we're using is current as of November 1st, 2025.
Okay.
And this whole dive really centers on this fundamental tension around NIO. You know, the company trades on the NYSE, Hong Kong, Singapore.
Hmm.
And as of that date, November 1st, the closing share price was $7.25.
$7.25. And, that price immediately forces us to look at the central question, the dilemma for this whole company. Because NIO isn't just selling cars, right?
Not at all.
They're trying to build and run this, revolutionary full-service energy ecosystem that's all built around battery swapping and this kind of premium community thing. So the question is this incredibly costly, unique strategy? Is it a brilliant competitive moat that's going to lock things down long term?
Yeah.
Or is it just, an unsustainable cash-burning machine that's going to bleed them dry?
That's the million-dollar question, isn't it?
Yeah.
Or maybe billion-dollar question here. That tension really defines the whole investment case. Are they laying groundwork for something totally new, like an industry utility?
Yeah.
Or are they just spending way too much, way too fast before they can actually make money from it?
Right.
We really need to unpack the vision first, though, because if you don't grasp the sheer ambition, none of the financial pain really makes sense.
Okay, let's get into that vision then, understanding their unique strategy. So let's break this down. NIO's model is direct-to-consumer, right? Selling these premium smart EVs, cutting out the dealerships.
That's the core sales model, yeah.
Right.
But if you look at where the money actually comes from, the revenue split, it tells a story.
Okay.
Vehicle sales, that's the big one. In 2023, that was like 88.57% of their total revenue.
Oh.
So first and foremost, they make and sell cars.
Still a car company.
Absolutely. But the other slice,
Yeah.
that 11.43%, comes from other sales. And this is the strategically crucial part. It includes parts, services, but most importantly, the recurring revenue from their battery-as-a-service subscription. BaaS, they call it.
POS. Right, and that smaller piece, that's the core of their whole future bet, isn't it?
That's the thesis, exactly. Recurring revenue, ecosystem lock-in.
But the market doesn't just wait for the future. It rewards scale now. And you have to admit, their operational momentum, it's kind of staggering.
It really is. They just smashed their monthly delivery record in October 2025, hit 40,397 vehicles.
Wow, 40,000.
I mean, that's not just steady growth, that's explosive. A 92.6% increase compared to the year before.
92% year over year.
Yeah. That kind of jump suggests they probably cracked some major production bottlenecks. And demand, especially in that premium Chinese market, must be incredibly strong.
And the total volume backs that up. They're past 913,000 cumulative deliveries since they started.
Yeah, over 900,000. They're psychologically past that million car mark, really. That signals they're a serious industrial player now in terms of manufacturing, logistics. But volume alone, especially when everyone's cutting prices, it's only half the picture. Their really aggressive strategic move, the one that adds huge complexity and cost, is this multi-brand architecture.
Ah, right. They're not just staying in that top-end niche.
No way. They're going after the whole market.
And this feels like a really high-stakes play, trying to capture everyone from the luxury buyer down to the mainstream. Let's break down these three brands.
Okay, first you've got the NIO brand itself, that's the flagship, the tech leader. The premium sedans and SUVs, the ET5, the ES8, packed with features.
Competing with Tesla's high-end, the German luxury brand.
Exactly. That brand sets their tech standard, justifies the premium price. It's the halo.
Then there's the move into the mainstream, the really high-volume part of the market where companies like BYD make their money. That's ONVO, right?
ONVO, yeah.
Yeah.
ONVO. It's designed for that family-focused mass-market buyer. And its first big vehicle, the L90 SUV, has been a huge success. Really shows NIO can execute outside that luxury bubble.
How successful?
Well, it hit over 10,000 deliveries a month for 3 straight months, right after it launched in July 2025.
10,000 a month for a new model.
Okay, that's significant volume.
It really is.
But wait a second. If ONVO is going for the mainstream, fighting against low-cost giants like BYD, How do they keep their margins up? Isn't there a huge risk they just cannibalize the premium NIO brand while also getting squeezed on profits with these cheaper cars?
That is the critical risk.
Right.
We'll definitely dive deeper into the financials in Section 2. But yeah, managing 3 different brands, NIO, ONVO, and the third one, FIREFLY.
Ah, yes, FIREFLY. What's their niche?
FIREFLY is aimed at the small, sort of high-end, compact EV market. Think premium city cars, urban mobility.
So managing these three, separate supply chains, different development cycles, marketing, it's a massive operational challenge. And yes, it absolutely threatens to balloon their costs, SG&A, R&D, unless they hit incredible economies of scale very, very quickly.
So that multi-brand strategy is definitely risky, potentially margin-killing. Let's look at what they see as their ultimate defense then. The NIO power ecosystem. This is supposed to be the real differentiator, and it kicks off with battery as a service, BaaS.
BaaS is pretty clever, actually. It tackles the two biggest hurdles for EV adoption head-on: cost and range anxiety.
How so?
Well, by taking the battery out of the initial purchase price, they basically knock off around $10,000 or about 70,000 RMB instantly.
Okay, that's a big chunk off the sticker price.
Huge. It makes their premium cars accessible to way more people who might have otherwise just bought a cheaper competitor.
Yeah.
And the customer shifts from a big upfront cost to a, manageable monthly subscription, like Netflix for your battery.
A subscription, which then ties you directly into using their proprietary power swap stations, the PSS network. That's the physical part of this ecosystem.
Exactly. And the PSS network completely changes the whole refueling game.
Right.
A big pain point for EV buyers is waiting 30, 45 minutes at a fast charger.
Yeah, nobody likes that.
PSS fixes that with automation. A fully automated battery swap. The whole thing takes about 3 to 5 minutes.
3 to 5 minutes, seriously?
Yeah. That's basically the same time it takes to fill a car with gasoline. So for the driver, the inconvenience just disappears. And for NIO, it creates this massive infrastructure advantage that's hard to copy.
And they wrap even more around it, don't they? This idea of going beyond the vehicle. The NIO houses always come up.
You have to mention the NIO houses. They're often these really impressive multi-story spaces, like community hubs, part library, part cafe, part workspace, not just showrooms.
So building a community, not just selling a product?
Precisely. That's soft infrastructure. People often miss it in the financials, but it builds incredible brand loyalty, stickiness. They're selling an identity, a luxury experience.
Yeah.
That creates a switching cost that isn't just about money.
And they back it up with all the charging options too, right?
Everything. High-speed power chargers, emergency power mobile vans that come to you, power home chargers for your house. They cover all the bases.
Okay, so this whole package, BaaS, PSS, NIO houses, all the charging, this creates what you call the competitive moat and network effects. How does that actually defend them against rivals long term?
Well, the PSS network creates this classic, really powerful virtuous cycle. More cars sold makes the swap network more essential.
Right.
A denser network makes the BaaS subscription more attractive, which helps sell more cars. And here's the kicker. If you buy the car without the battery using BaaS, you're basically locked into the NIO ecosystem for as long as you have that subscription.
So switching cars means either buying a battery or finding another swap network, which doesn't really exist at scale.
Exactly. The switching friction is incredibly high.
But can't rivals just copy the battery swap idea? How strong is their defense there? Is it just the physical network?
It's way more than that. It's built on serious intellectual property. The report we looked at highlights over 1,200 patents just specifically on battery swapping tech.
1,200 patents just for swapping.
Yeah. And globally, they hold over 7,000 patents covering everything. Autonomous driving systems, their OMI AI assistant in the car. This is proprietary stuff. Tesla doesn't offer anything like battery swap, and rivals like BYD or XPeng would need years and, frankly, billions of dollars to even try to catch up, not just building stations, but navigating all those patents.
Okay, so it's a technically deep moat. Let's zoom out a bit. All this innovation, all this spending, it's happening while the whole industry tailwind is just massive, right?
Oh, the macro trends are incredibly strong for EVs. The global market is projected to explode from about $755 billion in 2024 to something like $4,360 billion by 2033.
$4.3 trillion.
Yeah. It's a generational shift in transportation. Companies that grab market share now stand to gain enormously down the road.
And China is ground zero for this, isn't it? It's still leading the charge. They sold, 11 million EVs globally in 2024?
China is the dominant force.
Right.
And the adoption rate there is just breathtaking. It's accelerating like crazy.
It's fast.
New energy vehicles, that's pure EVs plus plug-in hybrids, they hit a record 49.7% market share in China back in September 2025.
Wow, nearly half.
Almost half of all new cars sold there are now electrified in some way. It's an incredibly fertile ground for NIO to grow its volume.
But there's always a but. That fertile ground is also incredibly crowded. We have to talk about the intense competitive headwinds.
Oh yeah, it's a total bloodbath out there. NIO is up against global giants like Tesla, obviously dominant in premium EVs worldwide. Then there's the domestic behemoth BYD, using its scale and battery tech to push aggressively upmarket from its lower cost base.
And the other Chinese startups?
Right. You've got direct rivals like Li Auto, who focus more on those range extender plug-in hybrids, and XPeng, which is really pushing the software and autonomous driving angle.
So tons of competition.
Tons. And this pressure cooker just leads to these brutal cyclical price wars. Everyone's cutting prices to grab share, which just crushes margins right when NIO desperately needs to improve theirs.
Okay. So we've got the vision. A brilliant, potentially game-changing ecosystem, strong volume growth, huge market tailwind. But building it requires, catastrophic spending. It feels like time to slam this exciting vision into the maybe less exciting financial reality.
Yeah, this is where the story gets significantly tougher.
Yeah.
Let's pivot to the cold, hard numbers. This is really where the optimistic narrative meets the, mathematical reality of the business. And frankly, the financial picture poses the single biggest threat to NIO's long-term survival.
Okay, but let's give credit first. The impressive top-line growth is undeniable, right? They've successfully scaled revenue massively.
Absolutely. From about $2.5 billion in 2020 to over $9 billion in 2024. And their trailing 12-month revenue, as of our snapshot, is $9.544 billion. They can definitely sell the cars, no question there.
$9.5 billion. That's real scale.
It is. But, volume and revenue are ultimately vanity metrics if the business itself isn't structurally sound. Which brings us right to the elephant in the room. The massive profitability gap.
The bottom line.
Yeah. The stark reality is NIO has reported a net lost money in every single fiscal quarter and year since they went public.
Every quarter, every year.
That's just
since IPO.
Yeah.
That's chronic. If they've been around this long selling this many cars, why are we still waiting for profit?
Because the whole investment thesis, the whole strategy, requires them to prioritize building that scale, building that infrastructure over making money right now. They're spending ahead of earnings.
Okay.
And the market, the analysts, they seem to agree this isn't changing soon. The consensus forecast doesn't see them hitting quarterly profitability for at least the next 3 years. That requires incredible patience from investors.
3 more years of losses, potentially. Okay, let's dissect the margin pain. When they sell a car, how much are they actually making before all the NIO houses and R&D labs, just on the car itself?
Well, the gross margin is the first warning sign. In the second quarter of 2025, it was just 10.0%.
10%? That sounds low for a premium car brand.
It's incredibly low and volatile. For comparison, you look at Li Auto, they often report gross margins well over 20%. Tesla historically targets the mid-20s. NIO's 10% really highlights their high production costs, maybe issues with factory utilization, and definitely the pain from those price wars we mentioned.
And management's target is higher, isn't it? Like 16% to 20%?
Yeah, that's their goal. But bridging that gap from 10% to, say, 18%, that's where their entire future profitability hinges. It's a huge leap.
How do they even get there? What needs to happen?
It's a combination of things. They need better utilization of their factories, definitely. They need significant cost cuts in their supply chain. They need the price wars to ease up, which is, maybe wishful thinking. And crucially, those new brands, ONVO and FIREFLY, they need to become profitable quickly. Otherwise, they risk just dragging the whole company's margins down further.
Okay, so gross margin is tight, but then you have to subtract all the operating costs, the R&D for 3 brands, marketing, running that huge power swap network, the fancy NIO houses.
Yeah.
The picture must get way worse then.
It deteriorates very quickly. The operating margin, looking at trailing 12 months, is consistently substantially negative, around negative 26%.
Running at 26%.
Yeah. Investors kind of expect negative operating margins because of the heavy R&D spend in this phase, but the overall cost structure is just enormous. And then the final number, the net margin, PTM. It's deep in the red, approximately negative 35.0%.
Wow. Negative 35% net margin. So for every dollar of revenue they bring in, they're effectively losing 35 cents on the bottom line after everything.
That's basically it. It's like they're subsidizing every sale significantly just to build the user base and the network.
What are the biggest drivers of that massive loss beyond the low gross margin? Where's all the money going?
Two main culprits, R&D and SG&A, selling general and administrative costs. First, R&D. Their commitment to doing tech in-house autonomous driving, NOMI, AI, new vehicle platforms means they pour billions into it. It's vital for the smart EV premium image, but it's a constant cash drain.
Okay, R&D. What's the second one?
SG&A. This is where the base office structure in the NIO house is really hit hard. Maintaining and expanding that network of power swap stations needing real estate, power, maintenance, staff. It's incredibly expensive. And it's running at a massive loss right now before the ecosystem revenue really scales up. They're essentially building a utility company, and utilities always have huge upfront costs.
That level of loss, negative 35%, must translate directly into just burning through cash, right? This cash burn and financial strain. How fast are they actually using up their reserves?
We look at free cash flow, SCF for that. That's the cash left after all operating expenses and, crucially, capital expenditures, the money spent on building things like factories and swap stations.
Right, the real cash drain.
And the trend here is alarming. FCF went from negative $331 million in 2021 to an accelerating negative $2.296 billion in 2024.
Whoa, from negative $0.3 billion to negative $2.3 billion in just a few years.
Exactly. The cash needed just to run the business and keep expanding the infrastructure is getting bigger every year.
Yeah.
They're fundamentally funding today's growth with, well, money they hope to make tomorrow or money they raise today.
And if you look at how efficiently they're using all this money they're spending, return on invested capital, ROIC, must tell a pretty grim story.
It really does. ROIC measures how well management uses the money invested, both shareholder equity and debt, to actually generate profit.
Yeah.
NIO's TTM normalized ROIC is reported around negative 47.86%.
Negative 48% ROIC, that's brutal. For our listener, where did all that invested capital go to generate such a negative return? What did they spend it on?
Well, think about all the long-term assets that aren't really generating significant profit yet. Billions spent on buying land, constructing and equipping those power swap stations that aren't running at full capacity. Massive investments in their manufacturing plants. Huge R&D spending on tech platforms like their NT 2.0 architecture.
So the money's tied up in things that are supposed to pay off later.
Precisely. This deeply negative ROIC basically confirms that the capital they've deployed hasn't entered its productive phase yet. It's still in the build it and hope they come phase. Getting back to even zero ROIC requires huge improvements in efficiency, where the revenue from all that infrastructure finally starts covering its own costs.
Given this enormous need for cash, let's look at the balance sheet red flags. The immediate risks. Liquidity must be tight.
It is. The current ratio is the key metric for short-term health. It compares current assets cash, what customers owe them, to current liabilities bills due within a year. As of Q2 2025, NIO's current ratio was 0.84.
0.84. And anything below 1.0 is usually considered a warning sign, right? What does that mean practically for a company like NIO?
It signals a potential liquidity challenge. Think of it like your household budget. Your credit card bills and mortgage payment due this month are more than the cash you actually have in the bank right now.
They're out of comfortable position.
Not at all. It means they have to constantly rely on other means, maybe drawing down credit lines, selling assets, or, crucially, raising new capital just to cover their immediate operating needs. For a company burning cash this fast and spending heavily, a ratio below 1 suggests potential strain on paying suppliers or servicing debt in the near term.
That tight short-term picture seems to contrast sharply with their long-term debt situation.
Yeah, the long-term leverage is, frankly, staggering. The official debt-to-equity ratio is reported as very high, at 231.9%. But if you dig into the granular numbers for Q2 2025, looking at all their liabilities versus their actual equity, the ratio is something like 14 to 1.
$14 of liabilities for every $1 of equity.
Basically, yes. It signals an overwhelming reliance on debt and other obligations compared to the company's core ownership base. This makes them incredibly sensitive. Any slowdown in sales, any increase in interest rates, it hits them much harder because of this leverage. They're really walking a tightrope financially. Absolutely. They're leveraged to the hilt. Their whole operation depends on continuous confidence from external funders, which brings us neatly to management and their capital strategy.
Their focus seems laser sharp. Aggressive growth from within, not buying other companies, but pouring everything into R&D and expanding that power swap network.
Right. Organic growth is the mantra. And that means the CEO, William Lai, essentially has to act as a full-time fundraiser. They're constantly funding this growth by selling more stock, which dilutes existing shareholders. Your slice of the pie keeps getting smaller.
How significant has this dilution been recently? Have there been big raises?
Oh yeah, it's been central to keeping the lights on. The really big one was that essential $2.2 billion strategic investment from CYVN Holdings, that's the Abu Dhabi Sovereign Wealth Fund, back in 2023.
$2.2 billion. That's a lifeline.
A massive one. But even that wasn't enough. They followed up just recently in September 2025 with another big $1.16 billion equity offering, selling more shares to the public.
So basically raising billions every year or so just to keep going.
That's the cycle they're in right now.
Yeah.
It's the lifeblood of the business. If you hold the stock, you have to constantly ask yourself, is the potential future value they're creating with this cash worth having my ownership stake continuously reduced?
And because they're unprofitable and reinvesting everything, there's absolutely no capital return to shareholders, is there?
Zero. Forget dividends. And apart from some specific debt management moves, like they repurchased some convertible notes early in 2025, but that's not a stock buyback. They don't buy back their own shares. Every single dollar is being consumed by operations and expansion, chasing the vision.
Okay. Vision established. Financial reality. Sobering. Let's connect those dots now. So we've laid out this incredible potential, this unique vision, but also this extremely precarious financial situation. Now we need to really evaluate the risks that come from that conflict. It leads right to this strategic dilemma that seems to define NIO.
It really is the core trap. And the SWOT analysis in the report makes it crystal clear. Their greatest strength, the base moat, the R&D edge, the service ecosystem, is paradoxically the direct cause of their biggest weakness. The chronic losses and the massive cash burn.
They can't stop spending without killing the very thing that makes them special.
Exactly. They're caught. They have to keep feeding the beast to build the moat, but feeding the beast is draining their resources.
Which makes every operational decision incredibly high stakes. And adding that multi-brand complexity just layers on even more execution risk, doesn't it?
Oh, absolutely. Running 3 distinct brands, NIO, ONVO, FIREFLY, isn't just 3 times the work. It's way more complex than that. You've got potentially 3 separate supply chains to manage. You need to avoid confusing the market, develop unique marketing for each.
3 R&D streams.
Right, without just spreading your core tech too thin. And this strategy almost inevitably leads to margin compression because those high-volume, lower-priced ONVO and FIREFLY cars are going to make up more and more of the sales mix over time. Management has to execute this flawlessly to get the scale they need without completely destroying profitability in the process.
Okay, so huge internal risks. But they're also facing massive external headwinds, especially the geopolitical threat.
This is a major roadblock. The U.S. has slapped significant tariffs on Chinese-made EVs, batteries, key components. What that means practically is the huge, profitable U.S. market. It's effectively closed off to NIO right now.
So their entire global dream is suddenly squashed down into basically 2 main battlegrounds.
Pretty much. They're forced to concentrate almost entirely on the hyper-competitive Chinese market, which relies heavily on subsidies and government support, and the still developing complex European market.
That really concentrates the risk, doesn't it? No geographic diversification benefit.
Exactly. If China's economy slows down or if Europe puts up new regulatory hurdles, NIO's entire revenue base is immediately at risk. They don't have that cushion of selling into multiple, stable, high-margin regions.
Okay, given all this, the growth story versus the cash burn nightmare, the internal complexity, the external risks, it's no wonder the market polarization and valuations seem completely all over the place.
Wall Street is deeply divided on NIO. The overall analyst consensus rating is just a neutral hold, which basically means analysts are throwing up their hands saying, we don't know.
A hold rating. Okay.
But look at the price targets. The median 12-month target is $6.26.
$6.26. But the stock was trading at $7.25 when this report was done. So the average analyst thinks it's actually worth less than its current price.
That's what the median suggests, yeah. It implies the market price might be driven by recent momentum, or maybe overly optimistic hopes that the consensus just doesn't buy into yet.
In the range of those targets.
It's incredibly wide, from a low of $3, basically saying it's going much lower, to a high of $15. That huge spread tells you investors are truly split, believers versus skeptics, about whether the ecosystem dream will ever pay off before the cash runs out.
But then you have the technical traders, the chart watchers. They see something completely different, don't they?
Totally different story. From a purely technical perspective, the stock showed strong, positive short-term momentum at the time. The price, $7.25, was trading well above its 50-day moving average, which was $6.69, and significantly above the longer-term 200-day moving average at $4.75.
And you mentioned something called a golden cross happened earlier in 2025. For listeners who follow technicals, what is that and why do traders care?
Right, a golden cross occurred back in March 2025. It's generally seen as a strong bullish signal. It happens when the shorter-term moving average, the 50-day, crosses above the longer-term 200-day average.
Okay.
Technical traders see this as confirmation that the underlying trend has shifted definitively from bearish to bullish. So you had momentum investors piling in, betting that those record delivery numbers we saw in October were just the start of a sustained rally, regardless of the pretty terrible current financials.
So this clash, technical bulls versus fundamental bears, leads us right to the valuation paradox. Since they lose money, you can't use a normal price-to-earnings ratio. You have to look further out.
Exactly. You have to turn to models like the discounted cash flow, or DCF, which tries to estimate the value today of all the cash flows a company might generate in the future.
And what did the educational DCF model in this report suggest?
It estimated an intrinsic value of $11.42 per share.
11.42. Okay, that's significantly higher than the $7.25 market price at the time. That gap between $7.25 and $11.42. That's the whole story right there, isn't it? What is the market actually pricing in when it refuses to value the stock at its theoretical potential?
That gap, that difference of about $4.17 per share, it basically represents the market pricing in the immense execution risk. Investors are deeply skeptical that management can actually pull off the operational turnaround needed to generate those future cash flows.
What kind of turnaround are we talking about? What needs to happen for them to maybe reach that $11.42 value?
Well, the model implies they need to hit some pretty aggressive targets. Things like consistently keeping monthly deliveries above 30,000 units through 2026, achieving a gross margin of at least 15% on those high-volume ONVO cards within, say, 18 months, and successfully scaling up the profitable side of the base business, maybe through partnerships, by 2027.
So big improvements needed across the board.
Massive ones. The current market price is basically saying the odds of them failing to hit these tough targets are pretty high.
Okay, finally, let's touch on the very unusual ownership structure. That also seems to play into the stock's wild swings. It's like a barbell, right?
It really is. On one end, you have the general public. Retail investors hold the single largest chunk of the company, a massive 48%.
Almost half the company owned by individual investors.
Yeah. And that huge retail base means the stock is incredibly sensitive to news headlines, social media buzz, quarterly earnings reports. It drives a ton of day-to-day volatility.
But on the other end of the barbell, they have a huge stable anchor investor.
That's right, the Sovereign Wealth Fund of Abu Dhabi, CYVN Holdings. They own a massive 20% stake, making them the single largest institutional shareholder.
So Abu Dhabi provides a big financial backstop. Stability.
Invaluable stability in a strategic partnership, yes. But it also means NIO's long-term strategic direction is likely going to be closely aligned with the priorities of the UAE government, which might not always perfectly match what small or minority shareholders want.
And we should also mention the founder stake. William Lai still owns a big chunk, right?
Yeah, founder and CEO William Lai holds about 7.9% of the shares. So he definitely has significant skin in the game, which aligns his interests with shareholders to a large degree.
That's generally seen as positive.
It is. But the day-to-day reality of the stock price is often this tug of war between the, let's say, more impulsive retail crowd reacting to news and the very long-term strategic view of the state-owned anchor investor. That tension creates a lot of the volatility you see reflected in that $7.25 share price. #outro.
Okay, we've covered a lot of ground in this deep dive on NIO Inc. It really feels like a company that embodies this clash between, incredibly ambitious innovation and just unforgiving financial reality.
Absolutely. The bull case is clear. It rests on that potentially powerful BaaS and battery swap moat, backed up by genuinely impressive delivery growth and the market coverage they get from having 3 distinct brands.
But the bear case is just as stark, maybe even starker. You can't ignore the chronic negative 35% net margin, the accelerating cash burn measured in billions, that shaky 0.84 current ratio suggesting liquidity issues, and a balance sheet loaded with debt.
Right. An investment in NIO at this point isn't really a traditional calculation based on current earnings. It's an explicit wager. You are betting, plain and simple, that the future value of that whole ecosystem they're building will eventually become so large that it outweighs the monumental costs and the continuous shareholder dilution needed to actually finish building it.
And the market, by trading it at $7.25 against that theoretical intrinsic value of over $11, is basically saying, prove it. Show us the path to profit. They need something beyond just selling more cars at thin margins.
Which brings us to the critical next question, the one for you, the learner, to really think about. The core problem, as we've seen, is the immense ongoing cost, the capex, of building and running those power swap stations. To really turn the corner financially, they have to find a way to make money from that infrastructure itself, at scale. We know they've partnered with CATL, the world's biggest battery maker, to work on advancing battery swapping standards for the whole industry.
So if selling the cars is tough, maybe selling access to the infrastructure is the real golden goose.
That could be the pivot. The ultimate test for NIO's entire business model might be whether they can successfully shift that PSS network from being just an internal cost center supporting their own cars into an external revenue generator.
How would they do that?
Could they license their swap technology to other car companies? Could they start offering battery swapping as a paid service, like a utility, open to drivers of other brands that adopt the standard?
Interesting, like becoming the charging network, but for swapping.
Exactly. And it's a big if they can pull that off, generating high-margin recurring revenue that's independent of their own vehicle sales. That utility model might be the only thing capable of finally closing the huge gap between their massive spending and achieving sustainable profitability.
A truly fascinating test case of grand vision versus harsh economics. Well, thank you for joining us on the deep dive. We look forward to exploring the next critical topic with you soon.